What a year 2020 has been. I think to say eventful would be a massive understatement. I'm sure you've got your favorite pictures or videos that you've seen to describe 2020. I'll just show you one of mine. I think it's quite classic. Where is it gone? Yeah, there we go. Um, Clearly, there's been some major unexpected situations happening by everybody. That just well describes it. So what have we experienced this year? Well, one thing that was also incredibly unexpected is how investment markets have recovered since the pandemic. I don't think any of us would have imagined that down in March, global markets would be up over 17%, and even our local market up over 7.5% from that point. Just for our particular investors, those in our balanced portfolios or the provident funds at Allen Gray, over 6%. It's done quite nicely as far as the peer average of 4.8, but still, none of us would have expected this back in March. So we just wanted to analyze it a little bit and see where this has come from, because that can help us to see what we should expect over the coming months and years. So one thing that's come out of this, maybe you've seen it before, is a K-shaped recovery that many are talking about. Those that had before the pandemic have more, and those that didn't have even less. And it's played out in various themes. For example, this global equity of 70% is dwarfed by the 55% over the same period that the technology stocks have enjoyed. And there's just been a massive run in technology stocks compared to the rest. This has been going on for a while now. You can see back from 2015, all these phantom stocks, compared to, this is now the American Stock Exchange, the S&P 500. Excluding those, it's been pretty much flat over the same period. Even in South Africa, there's been a big difference between the large cap stocks, those that have a lot of their earnings and growth outside of South Africa, versus the smaller ones, which are much more exposed to South African economics. Actually, still, they haven't recovered basically since the beginning of the year. They're still minus 6%. A good example of this as well is in the US, the overall unemployment figures are much better. But if you see divided up into income brackets, those higher earners are much better off than the lower earners over this period. So what does this all mean? It just does tell us that there are certain areas within the markets that are doing really well and others that are actually doing a lot worse than we even realize. And these are definitely things that we need to watch. For example, if inflation does start creeping up and interest rates have to rise, then those companies that are in a lot of debt will be in a lot of trouble. Also policy changes, so antitrust laws that are being promulgated in America, and those could severely affect those phantom stocks that we looked at just now. Monetary policy, economic stimulus by the developed world, that could very much determine if this growth trajectory carries on or not. And locally, there's always talk about structural reform and anti-corruption, and whether that happens or not will make a massive difference to those local stocks, those that are exposed specifically to South African businesses. There has been some very positive news as far as that goes, and even on our blog on the website, some positive news there, which could mean good things in the near future. Things not to watch: sensational news. Maybe you saw in the news a while back, they spoke about this 51% drop in GDP And that was really a tweaking of the numbers. It was at the end of the second quarter, there was a 16% drop, which is obviously massive. But when that was annualized along with the first quarter, it gave this 51% figure. But the third quarter now has just come out, and that's been an increase of 13.5%. Obviously, still a drop for the year, but nothing like the 51% that we saw in the news. Politics, protest action, it's almost like investors are ignoring all this noise because there's just so much of it. And no matter sort of how bad it is, they're just almost looking to the future and assuming that things will get better. And so those things have less and less effect on investment returns now. Things we should do is diversify. So because there's these extremes in the markets, there's potential for those that have made massive losses to recover enormously. There's also potential for those that have done extremely well to not be able to maintain that momentum. And so having a properly diversified investment really does make a massive difference now, especially with these extremes. For personal business opportunities, there's always a silver lining to every cloud. I just heard the other day, those that are building rooms onto houses, they got more work than they know what to do with, because everyone now wants an office at home. Those that are selling office equipment and office chairs, for example, never sold so many in their life. So look for those opportunities in our own businesses. Things not to do, obviously make emotional decisions. There is going to be more volatility. There's going to be more bad news. But it does show that over time, companies have to continue. Those that survive have to keep making a profit and growing. Just a final slide, just something positive. Those in our annuity portfolio, those are retirees mainly, have done really well for the year, especially compared to their peers in the South African multi-asset medium equity and low equity class, 8% versus 4.7%. And that really just shows that this properly diversified strategy, not being linked to any fund for any motive other than finding the best fund, does work. And we just want to say thank you very, very much to all our clients for sticking with us for the ride for this year. We really appreciate that. And we look forward to helping. If there's anything we can do, questions we can answer, please let us know. And we'll do our best to help you. But otherwise, have a safe and relaxed holiday, and we will see you all next year. Thanks very much.